Hello friends, welcome to my channel. This is C. Rakhi Agarwal. Today's topic is related to Indian Accounting Standard 105, that is non-current asset held for sale and discontinued operation. So in this standard we will discuss about the non-current asset held for sale and discontinued operation. In globally, IFRS 5 is related to non-current asset held for sale and discontinued operation. In India, in Ind AS 105 deals with this standard, and in old accounting standard AS 24, which deals with discontinued operation. Non-current asset held for sale, there is no such separate standard for that, but in case of tangible asset, AS 10 is there to deal with that, and in case of intangible asset, there is a standard AS 26 which deal with. So non-current asset held for sale, for that purpose, there is two standard previously as per old GAAP, that is AS 10 and AS 26. And for discontinued operation, there is a separate standard as per Indian GAAP, that is AS 24. So this is the small brief of these standards, which standard deals with non-current asset held for sale both in India and globally. Now we will discuss about the content of these standards. So in these standards we will discuss about the objective of these standards, then we will discuss about the scope, then we will discuss about the definition of non-current asset held for sale, both how the treatment will be done as individual asset, disposal group of asset, and discontinued operation. Then we will discuss about the condition to be fulfilled to classify non-current asset as a non-current asset held for sale. So what are the conditions to recognize non-current asset as non-current asset held for sale? There is some conditions, so we will discuss that. Then there are exception rules to that. Then there is a concept of abandoned assets. Then how we will measure, how these standards says about the measurement principles, and also the subsequent measurement of the non-current asset held for sale. Then allocation of impairment loss in case of disposal group of assets held for sale. Then if there is a change in plan to sell the asset, then what was the treatment is to be done, how the situation is to be dealt with, then concept of discontinued operation, then presentation and disclosure, and then some key differences between Ind AS 105 and AS 24. So these are the contents which we will discuss in this standard. So let's start. Firstly, we will discuss about the objective of these standards. These standard is generally deals with accounting for asset held for sale, and also the presentation and disclosures of discontinued operation. If an entity want to sell a factory in which in that factory there is a equipments, there is a raw material, there is a plant machineries, and the owner only want to sell the building of that factory and want to shift all the equipments, all the materials to another factory, to its another factory. So it is a only the building is to be sold, then it is an individual asset which is held for sale. Only the individual asset they want to sell. And if the entity wants to sell the whole building along with the machineries and along with raw materials, then it's a disposal group of assets. They are disposing of, along with the building, all the assets belong to that factory. And also if they want to discontinue their operations, like there is a two segment, and an entity want to discontinue one of its segment, one of its vertical, so that is treated as a discontinued operation. That is not a disposal group, because in case of disposal group, company shift its business to another factory, but in discontinued, company totally discontinued it, one of its vertical, one of its line of business. So it's a discontinued operation. So how the company make the presentation and disclosures of discontinued operation, it should be said by this standard how to deal with that kind of situation. So the objective of these standard is to specify the accounting for asset held for sale, both the individual asset and disposal group of assets, and also the presentation and disclosures of discontinued operations. Now the scope. The classification and presentation requirement of Ind AS applies to all the recognized non-current asset and also to all the disposal group of an entity. Means recognized non-current asset means as per Ind AS 1, the presentation of financial statement at that time, the company recognized their asset as current and non-current. So recognized non-current asset, if it is to be fulfill the criteria of Ind AS 105, then only it will be shifted from non-current asset, recognized non-current asset, to non-current asset held for sale. So what we will just go to the brief definition of non-current asset. All other assets shall be classified. Means all other asset means what we will discuss, the current asset. All the other than current asset is to be classified as non-current asset. So what do you mean by the current asset? As per Ind AS 1, the entity shall be classified as asset as a current when it satisfies any of the following criteria. It expects to realize the asset or intend for sale or consumption in the company's normal operating cycle. What was the means? It is expected to realize or intend to sell or consume that material within the normal operating cycle. What was the normal operating cycle? Normal operating cycle is the time gap between the acquisition of assets for processing and their realization in cash or cash equivalent. Or if there is no such time, when the normal operating cycle cannot be identified, it is assumed to have a duration of 12 months. Or what was the other condition? It is held primarily for the purpose of being traded. If it is held for being traded, that is to be treated as a current asset. It is expected to realize within 12 months after the reporting date, then it is treated as a current asset. And it is, if it is a cash or cash equivalent, unless it is restricted for being exchanged or used to settle a liability for at least 12 months after the reporting date, then it is to be treated as a means these all are the assets which are treated as a current asset as per Ind AS 1. But if other than all these, other than current asset, all the assets shall be classified as non-current. Like for example, all the assets other than current assets is to be treated as non-current asset. Like for example, property, plant and equipment, investment properties, WIP. Then there is an asset called biological assets, then investment properties. All these assets are to be treated as a non-current asset. But if that asset which is recognized as non-current asset as per Ind AS 1, then that asset is to be, if it fulfill the criteria of Ind AS 105, then it is to be treated as non-current asset held for. Then the measurement requirement of these Ind AS applies to all recognized, which is already recognized by these standard by Ind AS 1, presentation and preparation of financial statement and disposal group, except for scoped out asset which are shown below. Means the measurement requirement of these Ind AS applies to all the recognized non-current asset and disposal group, except for these assets, below mentioned assets. What are they? Deferred tax assets. Ind AS 12 is there. There is a separate standard for that. If a disposal group includes any assets which on which the deferred tax asset as per income tax is computed, so that asset, for that asset there is a separate standard Ind AS 12 which deals with. So it is out of the purview of Ind AS 105. If the disposal group of asset includes the asset which arise from the employee's benefit, then there is a separate standard for that, that is Ind AS 19 which deals with. And if the disposal group of asset includes financial assets, within the scope includes also the financial assets, so there is a separate standard Ind AS 109 to deal with the financial instruments. And if the disposal group of assets includes non-current assets that are measured at fair value less cost to sell in accordance with Ind AS 41, so that agriculture, so there is a separate standard for that. And Ind AS 105 is out of that. Or contractual right under insurance contract as defined in Ind AS, that is insurance contract. So there is a separate standard for that to deal with. If there is a separate standard, means all other assets, means the measurement requirement of these Ind AS 105 applies to all recognized non-current asset and disposal group except these assets. Except these assets, there is a separate standard for that. So now, non-current asset held for sale. What do you mean by non-current asset held for sale? Non-current asset held for sale means the term refers to an individual asset and also the group of assets, like a factory building. If an entity want to sell only the factory building, then that is the individual asset which is already recognized as a PPE in the balance sheet. Now they will want to, the entity want to sell that factory, only the factory, not the equipments in the factory. So that factory is to be treated as an individual asset. But if the company, if the entity want to sell along with the building all the equipments, all the raw materials, all the plant machineries in the factory along with that, along with the building, so that is the group of asset. Though, so non-current asset held for sale refers to an individual asset also, and also a disposal group of asset. Now, an individual non-current asset is regarded as held for sale if its carrying amount will be recovered principally through a sale transaction rather than through continuing use. Means they don't want to use that asset anymore and they want to recover that carrying amount principal fully recovered through sale transaction. And disposal group is a group of asset to be disposed of together as a single transaction together with liabilities. If in any disposal group there is a loan inbuilt in that along with the assets, and the entity want to dispose of the liability also, so that also will be treated as a single transaction directly associated with those assets that will be transferred in that transaction. And the group also includes, if a disposal group also includes a goodwill if acquired in the business combination, if the group is a cash generating unit. So disposal group also includes the not only the assets but also the liabilities, and also includes the goodwill also which is acquired in the business combination. So non-current asset held for sale refers both the individual assets and also the disposal group of. Now, how the entity will classify that as a non-current asset? Classification of non-current asset held for sale. asset classified as non-current asset in accordance with Ind AS 1. As we have discussed, whatever the assets which are not a current asset will be treated as a non-current asset, and we will discuss the definition of current asset in our previous slides. So, asset classified as non-current in accordance with Ind AS 1 shall not be reclassified as current until they meet the criteria to be classified as held for sale as per these standard, as per Ind AS 105. It means that whatever the asset which is classified, already classified as per Ind AS 1 as non-current asset, which is not to be reclassified as current until, we will not say that, we will, non-current asset is not to be reclassified as current until it meets the criteria of classification as per Ind AS 105. So, non-current asset held for sale is a current asset if it fulfill the criteria of Ind AS 105. Asset of a class that an entity would normally regard as a non-current asset that are acquired exclusively with a view to resale shall not be classified as current. Means exclusively that are acquired for the purpose to resale shall not be classified as current asset, and unless they meet the criteria to be classified as held for sale as per Ind AS 105. So, asset of a class that an entity would normally regarded as non-current that are acquired exclusively for the purpose to resale shall not be classified as current unless it fulfill the criteria or classification definition or as per Ind AS 105 as held for. Now, what was the definition? Classification as held for sale. What was the criteria for that? An entity shall classify as non-current or disposal group as a held for sale if the carrying amount will be recovered principally through sale transaction rather than through continuing use, as we have discussed. An asset or disposal group must be available. Means, in case of individual asset, carrying amount will be recovered principally through sale transaction rather than through continuing use. Means, an entity no more want to use that asset and they want to recover that amount through sale transaction, then that asset is to be treated as non-current asset held for sale. In case of individual asset, and in case of disposal group must be available for immediate sale in its present condition. If any asset or disposal group must be available for immediate, they want to sell that asset immediately in whatever the condition of the asset in its present condition, and the sale must be highly probable. That is, probable means the management must committed to dispose of. The commitment is given by the management that they will dispose of the asset immediately in its present condition. If that condition is to be satisfied, then it is to be treated as a non-current asset held for sale and cannot be classified as held for sale if entity intend to sell it in a distinct future. If it want to sell in a future date, means not immediately but in future, then it not be classified as a held for sale. Meaning of available for immediate sale. It means to qualify for classification as held for sale, uh, the asset the asset must be available for immediate sale in its present condition, subject only to the terms that are usual and customary for sale of such assets or disposal group. It means that in our example, suppose if an entity want to sell a building, but it want to sell immediately. The intention of the management is to sell the building, and the intention and there is also an ability to sell the building. There is no such restriction imposed on the building that they will not sell. So there is must be an intention that management want to sell the building, and there must be an ability. Suppose we will take the example, suppose an entity want to sell a building, but a court imposed a stay on that building, that they will not be able to sell that building by stay order. So the intention of the management is to sell the building, but they don't have the ability until and unless the court remove the stay. So they, in order to sell the building, there must be a condition. That condition is they will be available for immediate sale in its present condition, and also the entity has an intention and ability. Both the condition, intention is also there and ability is also there to transfer the asset. When these conditions will be fulfilled, then we can say that the asset is qualified for classification as held for sale. So it must be qualified for held for sale, must be available for immediate sale in its present condition, subject only to the terms that are usual. Means it will take some time, usual time, to sell that asset. It is not that Mr. X come and want to sell the property and they will sell and bas काम हो गया. नहीं, इसमें क्या है, some time is required to process, like to transfer the asset from seller to the buyer possession. So it's some registration is there, some process is there to transfer the asset. So that usual time is treated as under the terms, and that is customary for the sale of that asset. That time is customary for the sale of such assets. So that time is treated as a yeah, immediate sale in its present condition. But if you can say that, yeah, we will our intention is to sell the asset, but we want to construct one more floor to this building. So that time, that is the more time it will require to construct. Until and unless the construction is not completed, you will not be able to sell. So that is not satisfying the condition of immediate sale in its present condition. If you want to sell the asset in its present condition, whatever the condition they are present, you want to sell it immediately, subject to usual time which is required to fulfill the terms and conditions to sell the asset, which is customary for such assets. So that is okay, that we can say that immediate sale. But if you will say that we will our intention is to sell the asset, but we will sell after 2 years, or we want to construct one more floor to the organization or one building, and then we will want to sell the asset, then it is not in fulfilling the condition of immediate sale in its present condition. So next criteria is to, this is to be taken to meet the entities currently has the intention and ability to transfer their intention and ability. Intention, we had taken the example, and management want to sell the factory. The intention is present, but management want after fulfilling his order, after completing his order, whatever the pending order he has, he want to complete that. So he has the intention to sell, but he don't have the ability right now in its present condition to sell that asset. He first want to fulfill, complete the order, all its pending order, then only he want to sell. So both the condition you has to satisfy, immediate sale in its present condition and intention and ability to transfer the asset. So in its present condition, so if that condition is present, then only it will be classified as held for sale. Non-current asset classified as held for sale. Explain with the help of example the meaning of the availability in the present condition, availability for sale in its present condition. An entity is committed to plan to sell a factory. The production cycle is 6 months and pollutants are involved. Means the company want to sell a plan. committed a plan to sell a factory, and the production cycle is 6 months, uh, and the pollution is also involved in that, and the company must meet its existing order. Dismantling the equipments and cleaning up the pollution will put the facility out of the action for 6 months. Does the factory meet the criteria of availability for immediate sale? Means in this question, the company entity committed to plan to sell a factory. The production cycle is of 6 months, and pollutant are also involved in that. Company meets the existing order. Company meets its existing order, like dismantling the equipments, dismantle the equipment and cleaning up the pollution will put the facility out of action for 6 months. Means it is not means the company, though the company meets the existing order, but in order to dismantle the equipments, cleaning up the pollution, it will take 6 months to means to do all that. Does the factory meets the criteria of availability for immediate sale? Answer is no, because there is some pending work is there uh, to dismantle the equipments to clean up the pollution. So it will take 6 months to do that. So it is not available for immediate sale. The fact that several months must be spent fulfilling the existing order and then dismantling and cleaning up the factory means that is it is not available for immediate sale in its present condition. Therefore, the factory cannot be classified as held for sale at the date of the decision to sell, until and unless they will decide to sell or to clean up to fulfill the existing order or dismantle and clean up the factory. It will take several months to do that. So until and unless the final decision comes out, it will not be recognized as a, it will not be treated or time to vacate. An entity is committed to plan to sell its headquarter and has initiated action to find a buyer. Means an entity firstly planned to sell its headquarter, and he started searching a buyer in order to sell its headquarter. The situation one is the entity want to sell when it vacates. As and when he vacate the building, it will take normal time to do the processing of transferring the asset from seller to the buyer. Means some paperwork are there to registration process is there to transfer the building from seller to the buyer. So it is a normal time. So it is the condition is meeting at a planned commitment date. So this is to be said as uh, that immediate sale, the entity wants to sell immediately. But if the entity wants to intention is there to sell its building, until and unless they will not construct a new headquarter. After they make a new headquarter, they transfer all the assets of old building to the new building. When the construction is completed of the new headquarter, then only they will shift. In that case, this delay demonstrate that the building is not available for immediate sale, because a delay is due to the construction of new headquarter. Until and unless the construction is not completed, the entity will not classify that asset as held for sale, and these delay demonstrate that it is not available for immediate sale, and thus the criteria is not meeting, even if the purchase commitment has already been entered into, even a contract has been entered into, but there is a delay in delay is due to and these delay due to the construction demonstrate that it is not available for immediate sale, and it is not fulfilling the condition classification condition as per Ind AS 105. So it is not classified as held for sale. Plan to sell or backlog of the customers. An entity is committed to plan to sell a manufacturing facility and had initiated an action to locate a buyer, but there is a backlog of customer order. It means an entity want to sell a manufacturing unit and initiated to find out the buyer, but there is some pending orders which an entity want to fulfill. So two conditions are there. The first condition is the entity intend to sell the unit, manufacturing unit, with its operation, along with its operation, and any uncompleted order will transfer to the buyer. Means a entity want to sell immediately with its operation, and any order, any pending order will also be transferred to the buyer. So it is this in this case the condition is the immediately the entity want to sell the asset. So it will be classified as held for sale. Because the condition for availability for immediate sale in its present condition are meeting. So condition will be made at a planned commitment date. In the second situation, the entity intend to sell the manufacturing unit but without its operation, and it does not intend to transfer it until it eliminates the backlog of the order. Means in that case, the company want to complete its order, company want to sell the factory, but after completing its orders, all the pending orders after completing, so it will take time. So company does not want to sell the unit along with its operation, along with its order. So it will take time to complete the order. So the delay is there, and it is not available available for immediate sale in its present condition. The intention of the management is there, but ability is not present. So delay means that the facility is not available for immediate sale, and thus the criteria is not meeting until the operation cease, even if a firm purchase commitment were obtained before operation ceased. Even there is a contract between the buyer and seller, but the condition as per Ind AS 105 is not meeting because it is not available for immediate sale. So it is not in second scenario, it is the criteria is not fulfilling, and the because it is not and the facility is not available for immediate. Now what do you mean by highly probable sell? Means in two situations is there to classify as held for sale. First is immediate sale in its present condition, which we had discussed, and the second is highly probable. So highly probable sale criteria is if and management want to sell immediately its building, and then and the in its present condition, then the second thing the entity will check that there is highly probability to sell that asset. So sale is highly probable when the management committed to plan to sell the asset. Management by board resolution or by meeting in the board resolution, they will decided to commit to sell that asset. Firstly, the sale is highly probable when management decided to sell that asset by by doing the board resolution, and they may started searching a buyer. They started searching or initiating a search to active program has been initiated to search a buyer, to locate a buyer. They have started to find out the buyer. Firstly, management decided to sell the asset by passing a board resolution. Then they have started to search, initiated to search or locate a buyer. Then active marketed for sale at a price that is reasonable in relation to its fair value. They decided a fair prices which is reasonable. They decided a reasonable price to sell that asset. Active marketed for sale at a price that is reasonable in relation to the fair value. So fair value is to be decided, reasonable price is to be decided by the management at what price they will sell that asset. Then the sale should be expected to qualify for recognition as a completed sale within 1 year from the date of classification. When they will classify that asset as non-current asset held for sale, from that date they will actually sell the asset within 1 year from the date of classification. So there is a management decided to sell or expected to sell the asset within 1 year from the recognition of the classification. So sale should be expected to qualify for recognition as completed sale, means when the sale is completed within 1 year from the date of classification, unless and until some event which is under the entity's control arises. Means some suppose there is a period when the entity classified decided to sell the asset, and they started searching a buyer. They had decided at a price which is reasonable price at a fair value, and then they recognize that asset as held for sale. Now within 1 year they want to sell that asset, as a complete sale will be arises within 1 year. But there is some un event which is outside the control of the entity arises, like some court order came to stop the sale, some labor strikes comes out, some labor has done the strikes not to sell the property, or any creditors strike has to be done by the, so it will take more than 1 year to do the sale of that property. Some stay order came out, so it will, in order to sort that problem, it will take some more time. So until and unless that does not happen, it will be completed within 1 year from the date of classification. So this is are some events. Some lockdown came out, like in COVID scenario, some lockdown come out. So these are the events which are the entities which are not under the entity's control, like some earthquake breakout, some which is the event which is outside the control of the entity arises. Due to that there is a delay in sale, so in that case it will take more than 1 year. But in normal situation it will within the 1 year from the date of classification it will happen. Action required to complete the plan indicates that it is unlikely that plan will be significantly changed or withdrawn. Means action required to complete the plan indicates that it is unlikely that the plan will be significantly changed or withdrawn. Means unless and until the management decides in such stage the process has reached that they will not be able to change their plan to not to sell the asset. Means they had reached such an advanced stage that it is not possible for them to significantly change their plan or withdraw their plan. So action required to complete the plan indicates that it is unlikely that plan will significantly change or withdrawn. So it's such reached such an advanced stage that they will not be able to change their plan or withdraw their plan. Now, this is to be explained with the help of example, like example of highly probable sale requiring shareholders approval, like shareholders approval, board approval. It is necessary to sell the asset. At the end of the reporting period, ABC Company Board of Director has approved a plan to sell a non-current asset. They have approved a plan that they will sell their non-current asset, one of the non-current asset. The eventual disposal required approval by a majority of company shareholder through a formal vote, which will take place after the reporting period. So shareholders meeting will be held in AGM, and majority of the shareholders vote is required to do the process. At the end of the reporting period, a majority of the company shareholder has provided that the company will sign irrevocable agreement stating that they will vote in favor of the disposal. All the majority of the shareholders has decided in favor of the disposal of that asset. The highly probable test is met because the shareholders has irrevocable commitment committed to approving the transaction, and therefore the vote by the shareholders is merely a formality. So there is a highly probable because the entity has decided. There is a highly probability test that entity, the shareholders who majority of the shareholder has in favor of the disposal of that asset. So it's an irrevocable commitment by the shareholders. So in that case, it is highly probable that they will sell the asset. Now we will discuss the exceptions to 1 year rule. Previously, we had said that from the date of the classification, it will take 1 year to complete the sale. But there is some exceptions. What are the exceptions? An extension of a period to complete sale may extend beyond 1 year due to the circumstances outside the entity control. Means any circumstances which are not in the control of the entity, the complete sale may be extended beyond 1 year. So the extension may happen if the circumstances are beyond the control of the entity. What are the circumstances? Unexpected condition imposed by buyer or third party after the firm purchase commitment is obtained. Means after a binding agreement between the buyer and seller, the buyers decided impose some condition on the seller that look, we will purchase your property, but subject to the condition. There's some condition that you will clear off all your dues or liabilities or any means any pending liabilities is there on that asset or any litigation is there on that asset, kindly clear that litigation, then only we will purchase that asset. So if any for that purpose there is a delay beyond 1 year in that case. So unexpected condition imposed by buyer or third party after the firm purchase commitment is obtained. After a contract is obtained, if a buyer, if a buyer visited the premises, suppose seller want to sell the factory to the buyer, and buyer, there is an agreement between the buyer and the seller. When the buyer visited the factory, he found that there is lots of pollution in the factory. So he said that please clear the pollution, please clear all the pollutant equipments to the factory. After that only I will purchase your factory. So it's a unexpected condition imposed by the buyer. For that there is an unexpected delay beyond 1 year to make a complete sale. Another condition is unexpected circumstances that delay the sale or disposal of the asset or disposal group held for the sale, that there is some unexpected circumstances due to which there is a delay in sale, like you can say the covid, due to covid lots of agreements are delayed due to lockdown. Lots of agreement, if there is a between the buyer and seller, these are the unexpected circumstances due to any order imposed by the court to not to sell the property, or which is beyond the control of the entity, or due to creditor strike or due to labor strike, due to that reason the sale is delayed in order to settle the claim. So, for that purpose, if the sale is delayed or due to some natural calamities, for that purpose, if any sale delayed, so that is not in the control of the entity. Unexpected circumstances are there. So, in that case, if the sale is beyond 1 year, so it will be classified as a non-current asset held for sale. In such circumstances, asset or disposal group will be still classified as held for sale, because the conditions are not in the control of the entity. For that, there is a delay. So in that circumstances, it will be classified as a held for sale. Sale period beyond 1 year. This to be explained with the help of example like ABC Limited, an energy sector company, is committed to sell one of its business line. ABC want to sell one of its business line, one of its vertical, and these require regulatory approval. Government approval is required to sell that business line. It could take more than 12 months to obtain this approval. In order to get that approval, maybe it will take more than 12 months. So the time is not probable, so it will take more than 12 months. It is not under the control of the entity. However, a purchase commitment must have been signed before approval, but there is an agreement already done by between the buyer and the seller to sell the one of its business line. So agreement is already done, but approval from the regulatory authority is not approved. It will take more than 12 months to get the approval. So in these case, sale is highly probable. But in the present case, sale is highly probable within a year. But in this situation, the condition for exception to one rule, year limit, would apply. Means in this case, sale is probable that it will take place. Sale is probable that it will highly probable that sale will happen. But the situation is not in the control of the entity. For that, it falls under the criteria of exception rule. That is, sale will happen. Agreement has been signed between the buyer and the seller, but it will take more than 1 year to complete the sale. So in that case, it falls under the exception rule. Exception beyond 1 year. So yes, limit would apply. As the sale is highly probable, it will be classified as held for sale, even though it extend beyond 1 year. Means even though the time limit is beyond 1 year, it will still be classified as held for sale. An entity is committed to sell a manufacturing facility, but after a firm purchase commitment is obtained. Means the entity decided to sell a manufacturing unit. After an agreement is obtained, the buyer inspection identified environmental damage that must be made good, and this will extend beyond 1 year. However, the entity has initiated appropriate procedure to repair the environmental damage, and the sale remain highly probable. As the sale is highly probable, it shall be classified as held for sale. Means in this case, an entity is decided, committed mm, to sell a manufacturing unit and entered into an agreement, a purchase commitment already obtained between the buyer and the seller. But the buyer, after inspecting the factory, identified that there is some environmental issues to the factory, and impose some condition on the seller that, look, please repair this environmental damage, then only we will proceed with the complete sale. So it will take more than 1 year to to make the complete sale, because of in order to repair the environmental damage. However, the entity has initiated appropriate procedure to repair the environmental damage, and the sale is highly probable. Because an agreement is signed, the sale is highly probable, but it will take more than 1 year to complete the sale, and it falls under the exception rule. So it will be classified as a held for sale. Now, non-current asset as an abandon. A non-current asset or disposal group that is to be abandoned should not be classified as held for sale. Means this is to be explained with the help of example. Suppose there is two factory building, and during the peak season both the factory building are working simultaneously, but during the off season the entity stop one of the factory building and only run one of its factory building. Means out of the two, the entity stop one and continue with one of its factory buildings. So in two buildings they had continuously making a production during the peak season, but during off season one of the factory is abundant. They do not use one of the factory, and they only use one factory because there is no such demand of the production. So in that case they will not use one of its factory, they make it abundant, but during peak season they started using that factory. So a non-current asset or disposal group that is to be abandoned should not be classified as held for sale. But in that case, if the asset is not used but lying idle, it is not treated as held for sale, because during off season they are not using that factory, but during peak season they are using. So it is not to be treated as that asset is lying abundant, so recognize it as held for sale. So if an abandoned asset is there, then it should not be classified as held for sale. This includes non-current asset disposal group that are to be used to the end of their economic life, and non-current asset or disposal group that are to be closed rather than sold. Means even they are closed, but they are not treated as sold item unless and until the management fulfill the criteria as per Ind AS 105, because its carrying amount will be recovered principally through continuing use. Because through abandoned asset, the entity want to use that asset through its continuing useful life, and derive economic benefit from that asset. So in that case they will not be treated as a held for sale. This is to be explained with the help of example for abandoned asset. Suppose the entity ceased to use manufacturing plant because demand has declined. Due to there is no such demand, the entity stopped manufacturing a plant. How the plant is worked, maintained in a workable condition, and it is expected to be brought back into use in future when demand picks up. Means plan is means the entity stop using that plant because due to decline in demand, but the entity maintaining that in a workable condition, so they will use in future when the demand picks up. It is to be treated as an abandoned asset because it satisfies the condition, because they don't want to sell that asset, they want to use that asset in future. So it is to be treated as abandoned asset, not as a held for sale, because its carrying amount will be principally recovered through continuing use. Therefore the entity will not stop charging depreciation. They will continue to charge depreciation on that, or treat means they will not stop charging depreciation on it, and they will not treat it as a held for sale. This is because its carrying amount will be recovered principally through continuing use to the end of the economic life of that asset, because the entity will not stop charging depreciation or treat it as a held for sale, will not treat it as a held for sale. So it is not to be treated as held for sale because the entity want to use that asset throughout its economic life. Now coming to the measurement criteria, how to measure the asset held for sale. The measurement immediately prior to reclassification as asset held for sale, that is immediately before the initial classification of the asset as held for sale, the carrying amount of the asset is measured as per the applicable standard Ind AS, that is Ind AS 164038. Means before recognizing any asset held for sale, it is previously recognized as per the previous standard like Ind AS 16, Ind AS 40, Ind AS 38. After that only they will recognized asset, they will classify as held for sale as per Ind AS 105. Any impairment loss is recognized in PL unless the asset has been measured at a revalued amount under Ind AS 16 or Ind AS 38, in which case the impairment is accounted for as a revaluation decrease. Now the steps is to be, firstly we have to calculate the carrying value of non-current asset held for sale or disposal group of assets on the date of classification as held for sale. And the step, firstly we will calculate the carrying amount, then we will calculate the fair value less cost to sale on the date of the classification as held for sale. Then we will recognize lower of the carrying value or a lower of the step 1, that is carrying value of non-current asset held for sale on the date of classification, and also the fair value less cost to sell on the date of class. In both the step 1 and whichever is lower, we will recognize that only and pass an accounting entry on lower of the step 1 and step 2. So this is to be explained with the help of example, so it become more clear for us to understand how this non-current asset held for sale is to be recognized. This is to be explained with the help of example, like A Limited purchased a factory building on 1st April 2020 for 5 crores. The useful life of the factory building is 10 years. There is no residual value. The factory building has been classified as held for sale as on 30th September 2023, and you are required to show the necessary entries for these effect. The fair value less cost to sell as on 30th September 2023 is 3 crore. Solution become cost of factory building on 1st April 2020 is 5 crore. Useful life is 10 years. Depreciation per annum is 5 crore divided by 10, that is 50 lakhs per year. Date of classification as held for sale is 30th September 2023, and fair value less cost to sell as on 30th September 2023 is 3 crores. Now, firstly, we will find out the carrying value of non-current asset held for sale or disposal group on the date of classification as held for sale as per Ind AS 16, because on from the date of purchase we had the entity has followed an Ind AS 16 because it is an asset, it is a PP item, so it Ind AS 16 is to be followed from the date of the purchase. On the date like on 1st April 2022 2020, depreciation is to be charged as per Ind AS 16. So cost of the asset as on 1st April 2020 is 5 crores, and depreciation for the year 2021, 2021 22 and 22 23, that is for 3 years. Per year depreciation is 50 lakhs and 3 years is 1 crore 50 lakhs. So it was the depreciation, and depreciation till the date of classification, that is for 6 months also, like the classification date is 30th September 2023. So 6 months depreciation is also we charged, like so 1 year depreciation is 50 lakhs, so 6 months depreciation will be 25 lakhs, so it becomes 1 crore 75 lakhs. So carrying value as on the date of classification will be 5 crore minus 1 crore 75 lakhs, that is 3 crore 25 lakhs. So this is the depreciation carrying value as on the date of classification, that is on 30th September 2023. Now we have to calculate, because it is already given in the question. The fair value less cost to sell as per step 2 it becomes 3 crore. As it is mentioned in the question, it becomes 3 crore. Now we will recognize the lower of step 1 and step 2, that is we will recognize at 3 crore, because lower of 3.25 crore and 3 crore will become 3 crore. So how we will make an accounting entry? Firstly, on the date of purchase, we will make factory building PP account debit 5 crore to bank account on the date of purchase, and we will also make a depreciation entry. So depreciation for 3.5 years, depreciation account debit to accumulated depreciation, that is 1.75 crore, that is 1 crore 75 lakhs. We will to accumulated depreciation on the date of classification as factory building held for sale, that is on 30th September 2023. We will classify the factory building as non-current asset held for sale. So we will make a debit of non-current asset held for sale of the lower of carrying value, as we had calculated in step 1, and fair value less cost to sell as per step 2. So lower is 3 crore, so we will recognize that at 3 crore, and we will credit the factory building. So the carrying value of the factory building is 3.25 crores. So the differential amount is an impairment loss due to classification. So impairment loss is to be charged to P&L. So impairment loss account debit, that is 25 lakhs. So it will be charged to P&L. So in this way we will classify, make an accounting entry, make a measurement of non-current asset held for sale, because carrying value less, and step 1 we will firstly find out the carrying value on the date of classification, and we will also find out the fair value less cost to sell on the date of classification, and we will recognize lower of step 1 and step. How the entity should measure subsequently at the reporting date, how they will recognize, how they will treat the non-current asset held for sale on the reporting date. Means not on the date of classification, as we has discussed on the date of classification. Now subsequent measurement, that is on the reporting date, how they will treat the asset on the reporting date if the asset is lying on the books. Non-current asset held for sale is lying on the book, how they will measure that on the reporting date. Subsequently, non-current asset held for sale has to be remeasured on the fair value less cost to sale. If the fair value less cost to sell has subsequently increased, then the increase will be recorded only to the extent of earlier recognized impairment loss under Ind AS 105 and Ind AS 16, 38, 40, etc. Means on the reporting date, subsequently non-current asset held for sale has to be remeasured on fair value less cost to sell. If fair value less cost to sell has subsequently increased, means it will increased, then the increase will be recorded only to the extent of earlier recognized impairment loss under Ind AS 105 and Ind AS 16, 38, 40 if any. Means this is to be explained with the help of example, like in case 1, fair value less cost to sell on the reporting date will increase to 4.5 crores. Means previously, as we had discussed the previous example, we are continuing with that example only, and we just in that example we are recognized on the date of classification, we recognize that because on that date the fair value less cost to sell will be 3 crore. But on next year, that is on 31st March 2020, 2024, the cost to sell, fair value less cost to sell, become 4.5 crores. So how we will treat that? How we will treat that? Because we had recognized non-current asset held for sale at 3 crores. So we will, what we will do? We will just make an impairment loss. We will measure the impairment loss previously recognized. So up to what amount the amount is previously, impairment loss is previously recognized. Because in our example, previous example, we had make an impairment loss debited 25 lakhs, that is 0.25 crores. So we will adjust till that only. Means if the differentiation is 1.5 crore, but we have to book till the impairment loss we had recognized earlier. Like in our example, we had recognized till 25 lakhs. So non-current asset held for sale, that is factory building account debit, we will increase by 25 lakh, and we will credit the impairment loss reversal. Because the amount is increased, fair value less cost to sell is increased, so we will adjust that till the impairment loss recognized earlier. So reversal is allowed up to the impairment loss earlier recognized, and any gain on the impairment is not recognized in case of non. But loss is recognized subsequently. If any loss arises, then that loss is to be recognized up to the earlier impairment loss recognized, till that amount only. And if any gain in case of non-current asset held for sale is arises, that gain is not recognized. Now in case 2, if the fair value less cost to sell is decreased to 2.5 crore, then what we will do? We will recognize. In our example, we had non-current asset held for sale is to be recognized at 3 crore. Now the amount is decreased to 2.5 crores. So there is a loss of 50 lakhs. So that loss is to be recognized as impairment loss PL account debit 50 lakhs to non-current asset held for sale factory building 50 lakhs. So it becomes, in balance sheet it becomes 2.5 crores. Now whether depreciation will be charged after classification as held for sale, whether depreciation is allowed as per Ind AS 105 if it is classified as current asset held for sale. No, in current asset depreciation is not charged. And because it is not, depreciation is charged on the use of the asset. The intention of the management is to use the asset. But in case of classification as held for sale, no, once asset is classified as non-current asset held for sale, then depreciation and amortization will be stopped immediately, because the intent of the company is to not get the future economic benefit by using the asset. Rather, the primary intent is to sell the asset, because the intention of the management is to sell the asset, not to use or to derive the future economic benefit from that asset. So depreciation is not allowed. Depreciation is to be stopped immediately as and when it is classified as non-current asset held for sale. So depreciation is not charged after classification. This is to be explained with the help of example. Like example, when sale is expected to be completed, if the sale is beyond control, if any sale is beyond, it is classified as held for sale, but it is beyond the control of the entity to sell that asset within 1 year, then how they will recognize that asset in the books, how they will measure that asset in the books. So this is to also to be explained with the help of example by using discounting factor at the present value. If the sale is completed beyond 1 year, if it take to sell the asset beyond 1 year, to complete sale beyond 1 year, so they will use a discounting factor, or they will use the present value factor to recognize or to measure that asset. So if the date of classification as held for sale is 30 September 2023, as we have taken our previous example on, that is initial recognition के टाइम पे जो एग्जांपल लिया वही ले रहे हैं अपने, or fair value less cost to sell. Fair value on the date of held for sale is 3 crores and cost to sell is 40 lakhs. And discounting rate will be 10%. Now we will find out the fair value less cost to sell. Fair value on the date is 3 crore and less cost to sell. We will discount the cost to sell at the present value. So we will divide that at 10% present value, that is 1.10 percentage. So it becomes less cost to sell becomes is 36 lakhs. So it becomes a fair value less cost to sell becomes 2.64 crore. Now we will make an understanding of concept of disposal group. We had discussed the individual asset. If an entity want to classify the individual asset, we had discussed that. Now we will understand the concept of disposal group. What do you mean by the disposal group? Disposal group is like a means if you want to sell an individual asset like any building, not along with that equipments and raw material, that is not to be held for sale. If any individual is building is to be sold, then it is an individual asset. But if you want to sell the whole unit, like along with building, you want to sell the plant machineries, you want to sell the whole unit of the organization, like its raw materials, its plant machineries, along with all inventories, financial assets, financial liabilities, so along with the goodwill also. In disposal group, goodwill also comes if acquired in case of business combination. So all the asset, if you want to sell in a one time, then it is to be treated as a held for sale, disposal group held for sale. So this is to be explained with the help of example like uh, goodwill. The carrying value as on 31st March 2023 is rupees in lakhs, that is 20 lakhs. PPE 60 lakhs, inventory 35 lakhs, financial asset 19 lakhs, financial liability 13 lakhs, and total becomes 121 lakhs. Under the Ind AS, a PP would be stated at 56 and inventory at 32. The fair value less cost to sell of the disposal group is 129 lakhs. Assume that the disposal group qualify as held for sale. So how the disposal group would be accounted for in the financial statement for the year ended 31st March 2023. Now we will find out the solution. Like step 1. Firstly, we will determine the carrying value of the disposal group as on the date of classification. We will find out the carrying value of disposal group as on the date of classification, like particulars, goodwill, property, plant and equipment, inventory, financial asset, financial liability. Carrying value prior to classification, like before classification, the amount will be, that is as mentioned in the question, that is 20 lakhs, 60 lakhs, 35 lakhs, 19 lakhs, 13 lakhs, that is total 120 lakhs. Now the date of classification becomes 30th, date of classification is 31st March 2023 only. So the carrying value on the date of classification is mentioned in the question, like PP would be stated at 56 lakhs and inventory would be 32 lakhs. So we will revise that amount. Revised carrying value will be goodwill as it is 20 lakhs. PP become 50 lakhs from 60 to it become 56 lakhs, and inventory from 35 it becomes 62 lakhs. It becomes 62 lakhs. And financial asset as it is, that is 19 lakhs, financial liability, that is 30 lakhs. In total it becomes 144 lakhs. Now impairment loss recognized. What was the impairment loss? we will the fair value, the group disposal value, that is the fair value less cost to sell of the disposal group is 129 lakh. So we had already find out the carrying value on the date of classification, that is 144 lakhs, and fair value less cost to sell, that is on the date of disposal, becomes 119 lakhs. Fair value less cost to sell, that is 119 lakhs. So differentiation become impairment loss becomes 25 lakhs. This is the difference. From step 1 and step 2, the difference is 25 lakhs. Impairment loss. This impairment loss as a whole is to be uh, apportioned with the asset, with the following assets. If any impairment loss is to be adjusted in case of cash generating unit with the goodwill. So goodwill is firstly adjusted, the whole amount of goodwill is to be adjusted in total impairment loss, that is 25 lakhs. The whole amount is to be adjusted firstly with the goodwill. So in our case 25 lakh is the impairment loss. We will adjust this amount firstly with the goodwill. So our goodwill is 20 lakhs. We will firstly adjust that amount with goodwill. So 20 lakh is to be adjusted out of 25. 20 lakh is to be adjusted with goodwill. Remaining 5 lakh is to be adjusted with PPE. Why? Because inventory is already measured at fair value. So if the item is already measured as per or cost or NRV, whichever is lower, so there is no question to revalue again at fair value on the classification, on the reporting date. So and financial asset is also to be recognized at fair value, and financial liability is also recognized as fair value. So it is, there is no question to determine again the impairment loss is to be recognized, they to measure that fair value, because the item is already measured at fair value. So that's why we are not adjusting that impairment loss with inventories, financial assets and financial liability. We will adjust that property, plant and equipment, because it is measured at a carrying amount, it is measured at carrying value, not at a fair value. So we will adjust that. After adjusting the carrying value after the impairment loss, it become goodwill becomes nil, because carrying value on the date of classification and impairment loss, after adjusting impairment loss, it becomes nil. Now property, plant and equipment, that is 56 minus 5, that becomes 51. Inventory, that is inventory as it is, it becomes 62. Financial asset as it is, it becomes 19, and financial liability becomes 13. So total it becomes 119 lakhs. So how we will make the accounting entry of that? The disposal group as a whole held for sale, that is 119 lakhs, is to be debited, because we have recognized fair value less cost to sell. We will debit the impairment loss by 25 lakhs. We will debit the financial liability, because financial liability is our previous financial liability which we are reversing, that is 13 lakhs. We are now, we will, what we will credit, we will credit all the assets. Because goodwill we will credit 20 lakhs, PPE by 56 lakhs, inventory by 62 lakhs, financial asset by 19 lakhs, and we will credit the disposal group liability. We will transfer whatever in disposal group by 13 lakhs. So this is the accounting entry. All the assets which are transferred to disposal group held for sale is to be recognized as 19 lakhs, and all the previous assets before prior to classification is to be credited. Impairment loss is to be debited. Previous financial liability is to be reversed by financial liability, and disposal group liability is to be credited. So in this way we will make the accounting entry. Now how we will make the presentation of that non-current asset held for sale in the balance sheet? How we will make the presentation? In the balance sheet, the major class of assets and liabilities classified as held for sale should be separately disclosed on the face of the balance sheet or in the notes. Means in the balance sheet, the class of assets and liabilities classified as held for sale should be separately disclosed on the face of balance sheet or in the notes. Thus, in this case, there would be separate disclosure of disposal groups as follow. Like non-current asset, there is an asset, non-current asset, current asset, and that non-current asset, if transferred, non-current asset disposal group classified as held for sale, that is 119 lakhs. Now in equities and liabilities, liability also, in case of liability, in current liability, we will disclose the liability directly attributable with disposal group held for sale, that is 13 lakhs. In this way, the presentation is to be done when they had decided to change to, to a plan of sale. When the asset, when the asset held for sale, when the held for sale criteria are no longer met, the asset should be removed from held for sale category. Means if the criteria of held for sale are no longer met, means as per Ind AS 105, if the criteria is not meeting for held for sale, then they will remove from that category. The asset should be removed from held for sale category. Reclassify and remeasure at lower of carrying amount before the asset was classified as held for sale, adjusted for depreciation, amortization, revaluation that would have been recognized had the asset not been classified as held for sale, and recoverable amount at the date of change to a plan. When the held for sale criteria are no longer met, the asset should be removed from the held for sale category. When the held for sale criteria are no longer met, the asset should be removed from the held for sale category. Then they reclassify and remeasure at lower of carrying amount before the asset was classified as held for sale, adjusted for depreciation, amortization, revaluation that would have been recognized had the asset not been classified as held for sale, and recoverable amount at the date of change to a, and they will also measure the lower of carrying amount before asset was classified as held for sale, adjusted for depreciation, amortization, devaluation that would have been recognized that the asset has not been classified as held for sale, and recoverable amount at the date of the change of plan when the management decided not to sell the asset, again to reclassify that asset as DPP, then they will determine the carrying amount and also the recoverable amount. Recoverable amount, as Ind AS 36 says, that fair value less cost to sell, higher of the fair value less cost to sell and value in use. So as we have discussed this, so the higher of fair value less cost to sell and value in use, whichever is higher, we will treat it as a recoverable amount, and we will measure the carrying amount before the classification by charging depreciation on it, as the asset has not been classified, and also we will find out the recoverable amount, and we will take the lower of the two and recognize that amount as PPE again. So we will take the example in order to demonstrate properly. In case of a change in plan of sale, the asset is going to be reclassified in the normal non-current asset category again. Means in case of change in plan of sale, if the entity decided not to sell the asset is again going to reclassify in the normal non-current asset category again. Ind AS 16, 38 and 40. Machinery, like machinery, Ind AS 16, what it says, treated as per Ind AS 16. Firstly, at the time of purchase, it will be treated as Ind AS 16, that is machinery purchased is rupees 10 lakhs. As on 1st April 2021, life of the machinery is 10 years. So as on the date of purchase, we will recognize the asset by finding the accounting entry, that is machinery PP account debit by 10 lakhs to bank account, and at the reporting date, that is on 1st April 2022, that is on 31st March, we will charge depreciation on it, that is of 1 lakh. Then after charging depreciation as on 1st April 2022, the machinery, the entity decided to sell the asset and to reclassify as non-current asset held for sale because it meets the condition of Ind AS 105 and recognized as at lower of carrying value and fair value less cost to sale. So the cost of the machinery as on 1st April at the date of purchase will be 10 lakhs and the depreciation is 1 lakh. Then carrying value as on 31st March 2022 it becomes 9 lakh. That is the opening value as on 1st April 2022, and carrying value on the date of classification is 9 lakhs and fair value less cost to sell on the date of classification is 8 lakhs, and lower of the two is to be 8 lakhs. So it will be recognized at 8 lakhs and remaining amount is to be, the differential amount is to be impairment loss. So how they will pass the entry on the classification date? They will debit the machinery account by non-current asset held for sale by 8 lakhs, credit by machinery account PPE by 9 lakhs, and differential amount is to be charged as impairment loss in PL. And again the as on 31st, as on 1st April 2023, the management changed its plan not to sell the asset and again reclassify it as to PPE from non-current asset held for sale. So what they will do, they will recognize that they will pass the entry as machinery account debit PPE to non-current asset held for sale. But at what value? So how they will measure that value? They will measure the value lowered of carrying value on the date of the change in plan had the asset never been classified as held for sale, and also the recoverable value on that date, means fair value less cost to sell and value in use whichever is higher. Now, how they will compute the carrying value? Considering the machinery is PP since beginning, the cost is 10 lakhs, depreciation is for 21-22, it will be 1 lakh 22-23, means as because during 22-23 depreciation is not charged. But if the management decided to change the plan, they will remove that. They will not consider that 1 year. They will charge depreciation as the asset is not classified as held for sale. So they will charge the depreciation for first year and second year both, and the carrying value as on 31st March 2023 becomes 8 lakhs. Now step 2 becomes compute the recoverable value. Now recoverable value is given in the question, that is 7,50,000. Now we will recognize that the lower of two, that is carrying value since beginning and recoverable value on the date when the management decided not to sell the asset. So it becomes 7,50,000. So 7 lakh we will recognize the asset at accounting entry will be machinery account PPE by 7,50,000, and we will credit that by machinery account non-current asset held for sale, that is 8 lakh. The remaining 50,000 is to be. Now coming to the another topic, very important topic of this standard, that is discontinued operation. What do you mean by discontinued operation? Suppose we will take the example of Tata Motor. Tata Motor has different line of business, that is they has a retail business, they has a commercial business, they has a private business. So they want to discontinue one of their operation, one of the major line of business. From there, there is a they earn the operation, from that they earn the cash flow, they make proper reporting of that, proper segment reporting, proper asset wise, profit wise, liability wise, they make a proper segment reporting of that. So in that case, if the Tata Motor want to discontinue one of its operation, like they want to discontinue their retail business, so what they will do, they will fulfill, if they are fulfilling their, suppose Tata Motor want to discontinue one of the major line of business like retail business, in all over India, wherever the factory is situated of that retail business, so it represent that they want to discontinue their component, one of the important component from where they are generating cash flows, which can be clearly distinguished, which the operation is clearly different from other segments, from rest of the entity. So what do you mean by the discontinued operation? A component of an entity that comprise of operation and cash flow that can be clearly distinguished operationally and for financial reporting purpose from the rest of the entity. So if the Tata Motor want to dispose of or discontinued one of its operation, that is major line of business, both in major line of business and also in the throughout the geographical area where the business is located, they want to discontinue, then it will be considered as a discontinued operation. But if the Tata Motor want to only discontinued operation but don't want to sell the asset, they want to discontinue in a particular area, like in wherever the suppose the Tata Motor had a retail business in Gujarat, in West Bengal, or in UP. We will just taking a high example, just for example purpose I am taking the name of this state, it is not the actual figure. So we will just taking the example for understanding purpose, that the Tata Motor having a business in, like in Gujarat, you can Gujarat or Maharashtra, and they want to shift their Gujarat business, whole the Gujarat whole entity, whole operation, they want to shift to the means another, like in Maharashtra. So it's not a discontinued operation, it's a discontinued operation, but they don't want to sell the asset of that business, they want to use that asset of Gujarat business in their Maharashtra business. So in Gujarat, it's a discontinued operation, but it is not fulfilling the criteria of disposal group of asset. Why? Because they are not disposing the whole of their assets. They are just discontinuing their major line of business in that geographical area. So it represents a separate major line of business or geographical area of business. And also it is, in other words, we can say a component of an entity will have been a CGU or a group of CGU while being held for use, which is being held for use, it is known as a discontinued operation. But all discontinued operation is not a disposal group, and all disposal group of asset is not a discontinued operation. As I had said, that if the entity want to dispose of and want to discontinue its operation, but he don't want to use sell all of its asset which belongs to that operation, they want to shift that asset, the plant machinery, to its another line of business, so it's a discontinued operation in that area. But it is not a disposal group of asset, because they are not fulfilling the criteria of held for sale ability in its present condition, and highly probable, the sale is highly probable, they are not fulfilling the criteria of Ind AS 105 of the disposal group of asset. So it's a discontinued operation but not a disposal group of asset. So, discontinued operation is a component of an entity that has been disposed of or is classified as held for sale and represent a separate line of business. As I said that in Gujarat they have different line of business like retail business, they have a private business, they have a commercial business. So they have a major line of business and geographical area of operation, like in they have a factory in Gujarat and also in Maharashtra. They want to discontinue their Gujarat business, major line of business. So it's represent a separate major line of business or geographical area of operation. Is part of the single coordinated plan to dispose of the separate major line of business or geographical area of business. Like they, as a whole, they want to dispose of the retail business in all over, wherever the business is situated. They want to dispose that in major line of business all over the geographical area where the business is situated. And it is also considered as discontinued operation if a subsidiary is particularly acquired exclusively for the purpose of resale, then it is considered as a discontinued operation. So discontinued operation is a component of entity that has been disposed of or is classified as held for sale if it represents a separate major line of business or geographical area of operation. It is a part of single coordinated plan to dispose of a separate major line of business or geographical areas of operation, or if the subsidiary is acquired particularly or exclusively for the purpose to resale. So in that case, it will be considered as a discontinued operation. All discontinued operation is not a disposal group of asset, or all disposal group of asset is not a discontinued operation. So company PQR Limited has different operating segment, one of it which will solely produce electrical goods. All the electrical goods production facilities are situated in Central America. PQR Limited also had other operations in Central America for other operating segments. In April 2023, PQR Limited want to dispose of its electrical goods segment, which meet the definition of component of a business and represent a separate major line of business, and would therefore be considered as a discontinued operation. So they are meeting the criteria of definition of discontinued operation, as they are means they're one of the segment out of the 7 different segments they want to dispose of. They want to discontinued their major line of business, and in like their electrical segment they want to discontinue their electrical segment, which meets the definition of discontinued operation, which represent a major line of business because they have one of the line of business is the electrical goods segment. So they want to discontinue, so it is considered as a discontinued operation. Now another example is suppose Pizza Hut. Pizza Hut is a retailer of takeaway food of burger and pizzas. It decided to sell one of its outlet which is located in Chennai. Now they have all over Chennai, they have 200 outlets, out of which they want to discontinue, they want to sell, not discontinue, they want to sell one of its outlets. Means they have a 200 outlets in Chennai, they want to sell one of its outlets. So as per Ind AS 105, the criteria for health for sale is meeting as on, because on 1st September 2022 they are meeting the criteria of health for sale because they had a ability to sell the asset immediately. The sale is highly probable. So in their present condition they want to sell, and the sale is highly probable. The outlay actually sold on means they had decided to sell the asset, the management already decided and make a classification of that on, because they are meeting the criteria of 105. So they had classified that asset as held for sale, on 1st September 2022, but the outlay is actually sold on 30th June 2023. So management believe that the outlet is a discontinued operation. Management won't be able to decide whether it is a disposal group of asset or it is a discontinued operation, and want to present the results of an outlet as a discontinued operation. Whether management has done a correct way of presentation of that as per the standard, no, management has not done a fair presentation, because it is not a discontinued operation. It is a disposal group of asset as they are firstly, they are meeting the criteria of 105, though, so it is a disposal group of asset, and it is not, they are not discontinued their major line of business. They are just discontinued one of their outlet in all over Chennai, not whole. They are not discontinued in the whole state of Chennai. They are not discontinued their operation in the whole state of Chennai. So they are just discontinuing their operation, uh, one of its outlet in Chennai. The outlet which is decided to sell out by the entity in Chennai is a disposal group. It is not a discontinued operation. As it is only one outlet, it is not a major line of business or geographical area, nor a subsidiary acquired with a view to resale. So it's not meeting the definition of discontinued operation. It is meeting the definition of disposal group of assets. So it is a disposal group of asset, and management believe that it's a discontinued, which is not fair, which is not correct. Now, discontinued operation and asset held for sale. Some of the examples, whether it is a discontinued operation or asset held for sale. So there are four examples. We will discuss that. In first case, suppose A Limited dispose of a component of the entity by selling the underlying asset. Once dispose, they dispose of the component of the entity by selling the asset. Means all the asset is to be sold, and the sale transaction is incomplete at the reporting date. At the reporting date, the sale transaction not takes place, but the management decided to dispose of the component by selling the asset. So it is a discontinued operation also, because they want to discontinue one of the component, major line of business, and also they want to sell that asset. The management decided to sell that asset, even though at the reporting date it is not sold, it is an incomplete sale, it doesn't matter, but management intention is to sell the asset, and also they want to discontinue also. So it's a discontinued operation, and at the reporting date will be classified as held for sale. Suppose in the another example, PQR Limited has ceased activities that meets the definition of discontinued operation without selling any asset. Means in that case, management PQR Limited has decided they are meeting the definition of discontinued operation. They are want to sell. They want to discontinue their one of the major line of business in and also in geographical operation. So they are meeting the definition of discontinued operation, but they don't want to dispose of their asset. Means they don't want, entity don't want to sell the asset, though they are discontinuing their operation, but they don't want to sell the asset. So in that case, it is a discontinued operation, but it is not an asset held for sale. It is not an asset disposal group of asset held for sale. In example 3, MCA ceased activities and has already completed the sale of underlying asset at the reporting date. Means MCA ceased its activities and they had already, means they had decided to discontinue the operation. They discontinued their operation, and also they had disposed of, they had already, the sale is completed. At the reporting date, there is no such asset lying. So they had already, before reporting date only, they had ceased the activity and also sold the activity. So there is no case of asset held for sale, because at the reporting date it will be PR Limited will sell or has sold assets that are within the scope of Ind AS 105 but does not discontinue any of its operation. Means they want to sell the asset. Suppose they have an asset, they want to sell that asset and meeting the definition of Ind AS 105, but they do not want to discontinue. It's an example of Pizza Hut that they sold one of their outlet all over Chennai, but they don't want to discontinue the operation. So it's a disposal group of asset. It is not a discontinued operation. They don't want to discontinue their operation, but they want to sell the asset. Only they want one of this outlet they want to sell that they don't want to discontinue the whole line of operation. Now we will discuss about the presentation, how an entity will present the discontinued operation and disclosure. An entity shall disclose a single amount in a statement of profit and loss comprising the total of the post-tax profit or loss of discontinued operation and post-tax gain or loss recognized on the measurement at fair value less cost to sell or on the disposal of the asset or disposal group continuing the discontinued operation, or analysis of single amount in A into the revenue, expense, pre-tax profit or loss of discontinued operation, the related income tax expenses as required by Ind AS 12, and the gain or loss recognized on the measurement to fair value less cost to sell or on the disposal of the asset or disposal group consisting the discontinued operation, the related income tax expenses as required by Ind AS 12. The analysis may be presented in the notes or statement of profit and loss. In this way, we will present the discontinued operation, the income from continued operation, the income from revenue from discontinued operation, then expenses from continued operation, expenses from discontinued operation, then taxes from continued operation, the taxes from discontinued. In this way, we will present. Now, difference between Ind AS 105 and AS 24. Applicable guidance. In AS 105, there is a applicable guidance like non-current asset held for sale and discontinued operation, and in old gap like a accounting standard 24, there is a discontinued operation. It is considered as a discontinued operation. Scope. Ind AS 105 specifies the accounting for non-current asset held for sale and presentation and disclosure of discontinued operation. AS 24 established principles for reporting information about discontinued operation. The principal reporting information about discontinued operation, it does not deal with non-current asset held for sale, fixed asset retired from active use and held for sale are dealt in existing AS 10 PPE. Means there is a separate standard to deal with non-current asset held for sale, both in case of tangible and intangible. So AS 24 only deal with the discontinued operation, but Ind AS 105 deals with both the cases like non-current asset held for sale and also the discontinued operation. Now measurement and presentation. Under Ind AS 105, non-current asset held for sale are measured at lower of the carrying value amount and fair value less cost to sell and are presented separately in the balance sheet. AS 24 requires to apply the principles set out in other relevant AS. For example, existing AS 10 requires that the fixed asset retired from active use and held for disposal should be stated at lower of book value net book value and shown separately in the financial statement. So these are the differences. Thanking you for watching my video. If you like, please share, subscribe my channel so you will get the benefit of my upcoming videos. Thanking you.